Good investing is remarkably simple, but there's a level of sophistication to it that is regularly overlooked. In today's video, I'm going to go through 5 common investing mistakes that will be impacting your portfolio performance. I'm going to break each one down and I'm going to give you practical solutions to each one to completely turn things around. Mistake number 1, inferior stock picking. I've been an investing mentor now for over a decade, and during that time I've been in an interesting position where I've had an insight and deep dive into people's portfolios and their stock picking. From those portfolios that have performed reasonably well to others that have been a complete horror show. A common theme that runs all the way through these portfolios is a lack of a proven process to picking good stocks. Process that's simple to learn, simple to execute, and one that is repeatable over an extended period of time. We're talking 5, 10, 15, 20 years. Instead of a process, people usually end up picking stocks based on social media hype, endorsements, or their own biases. Ultimately, we buy stocks based on what we like. Apple and Tesla are good examples of that. These are classic examples of why people get caught up in the excitement and forget to do one of the most important things when it comes to picking good stocks, which is doing proper due diligence. But here's the truth, guys. If you don't have a solid process for finding quality stocks, your returns will be inconsistent at best. Good stock selection is the bedrock of a strong portfolio. I cannot stress that enough. The solution, leveraging the technology that is available to us today, specifically scanners and charting tools. The foundation of a portfolio to be proud of starts with finding the very best stocks. There are thousands of stocks out there across 11 major sectors. A quality scanner will filter that huge list down to the strongest stocks in the best sectors in minutes. Then charts and technical analysis will help you zero in on the very best stocks to add to your portfolio. Now here's the beauty to this systematic approach. It removes the guesswork and emotion from your stock picking. Remember, one of the first rules of sound investing is to ignore opinions, including your own. Scanners and charts help you do just that. They cut through the noise and focus on the stocks with proven performance. That's how you build a rock solid foundation for your portfolio. Now here's a pro tip. The stocks that grow wealth aren't found plastered all over our media channels. Else, as the saying goes, everyone would be rich. If you consider yourself an investor, then you must be able to find these stocks, these hidden gems yourself, using a structured approach. Relying on hype and hearsay simply won't cut it. Okay, mistake number 2, lack of a risk management plan. Once people choose a stock, they often allocate too much of their capital to that one stock. When that stock inevitably goes through a correction, emotions take over, bad decisions are made, and losses spiral out of control. Poor risk management is one of the quickest ways to blow up a trading account, especially with leverage. So what's the solution? Diversify with small position sizes. First, make sure you're picking high probability stocks, one with a statistical edge. This tilts the odds of profiting in your favor. Now, we'll never eliminate risk entirely. It's all about probabilities, but this is about making smart investment decisions. Second, only risk a small slice of your account, typically no more than 1 to 2% on each position. So instead of making the classic mistake of betting, say 10% on one so-called hot stock, spread 1% across 10 high quality stock picks you have properly vetted. See, we've gone back to making sure that we're picking the right stocks in the first place. This diversifies your portfolio and prevents devastating losses on any single one position. By combining quality stock selection with smart position sizing, you're massively increasing your chances of consistently profiting from the markets. You have managed your downside correctly, which is the hallmark of a good investor, but positioned to grow your upside and milk the market for everything it is paying out. Leave dealing with the emotional swings to those who simply do not want to be better. And let's not stop there. Wait until we go through the solution for mistake number 3. I will be sharing a pro tip with you on how to boost the profit from a stock without increasing the risk on your portfolio. Mistake number 3, poorly timed entries. This usually comes down to FOMO, fear of missing out. Maybe you rush into a stock early based on rumors and the hype and the excitement, or you chase a stock that's already gone parabolic, simply getting in too late as you have given into the hype. Again, this is the direct result of not having a reliable method for identifying the right stocks in the first place. Everything is interconnected and mistakes snowball into uncontrollable losses if you do not follow a structured, systematic approach. So what's the fix? It's all about timing your entry at the start of a fresh move up. But how do you do that? I developed a simple process called the 4-phase sequence method, or the 4PS method for short. So let's break each of these 4 phases down. Phase 1 looks at a stock's proven history of performance. Big past gains indicate big future potential. Microsoft is a perfect example, surging over 600% between 2016 and 2021. That's the type of track record you're looking for any stock that makes it into your portfolio. Now, phase 2 is a long sideways market, also called a consolidation. Ideally, we're looking for 3 to 6 months as a minimum. Think of the consolidation as the roots of a tree. The longer and thicker the roots, the taller the tree. For stocks, a lengthy consolidation of at least 3 to 6 months primes the stock for an explosive breakout to the upside and creates a base for the next sustained uptrend. You may have heard of the expression, the longer the consolidation, the bigger the breakout. Often these trading phases are merely well regurgitated expressions. Few grasp their implementation. Now you possess that knowledge by being able to identify phase 2. So for example, DE is a stock that was in our portfolio post-coronavirus. It went through a 30-month consolidation between 2016 and 2020. The subsequent breakout and trend was a 130% move to the upside between 2020 and 2021. DE is now creating the next phase 2 base, which it has been in for around 3 years at the time of this recording. When it does eventually break out, we can expect the next move up to be significant. Here's a pro tip. While we're waiting for DE to break out and move up, our scanners are busy at work finding stocks already breaking out and moving up. You see how we have come back to mistake 1 and ensuring you start by choosing the right stocks? I cannot overstate this enough that this is where it all stems from, making sure that you're consistently finding the best stocks on offer. Okay, so phase 1 is identifying a stock with a proven performance history, and phase 2 is waiting for that sideways market or consolidation of at least 3 to 6 months. Phase 3 is the initial move up and breakout from consolidation. This is where we prepare to strike, but we still need to apply an important but underappreciated investor skill: patience. I will do a deeper dive into applying patience in the final mistake. With phase 3, by applying patience, we aim to avoid a fake breakout. This is when a stock looks promising but reverses back into phase 2. This is a trap many get sucked into by simply being too eager to jump into the market, leading to losses or being stuck in a stock for a lengthy period with no growth. By applying patience, we let the stock first prove itself, stacking the odds further in our favor of a positive outcome. Smart, right? Okay, finally, phase 4 is when the stock confirms the breakout is legit. This is when we are ready to enter, right as a new uptrend is beginning. Nail this entry and you've positioned to capture the meat of the entire move up. Now, I created the 4PS method to dramatically improve my own stock picking and timing. Once it clicked for me, it changed everything. I'm sharing it with you so it helps you do the same. Let me know how you get on with it in the comments below. And remember that pro tip I alluded to in mistake 2 to help you accelerate the profits of a good stock? Once a good stock starts moving in our favor, we accelerate profit by strategically adding to our positions. The key is to buy the same amount as your initial size at specific intervals. Let's say 2% above your entry, then 4%, 6%, and so on. But by moving your stop loss to break even on your previous position, each time the new position is triggered, you are not adding any extra risk, but you are pyramiding your profit as the trend gains momentum. This is a powerful way to squeeze the most out of your winners, and how the finest investors and traders have done it since the dawn of the financial markets. Your upside is uncapped and your downside is capped. Smart. One more pro tip while we're at it. Only add to winning positions, never losers. Doubling down on the wrong stocks is a classic way to blow an account. So, expression time again. You'll likely be familiar with cut your losers short and let your winners run. Well, that is now no longer just theory. I have shared a proven way of turning that theory into execution. For me, the full expression is cut your losers short, let your winners run, and compound those winners only. Okay, mistake number 4, lack of a stop loss or one that's simply too tight. Taking positions without a hard stop is unacceptable. You're asking for trouble. But a stop that's too tight can also be troublesome. It'll get you whipsawed in and out of positions because of normal volatility, even if you're on the right side of the market. You need to give your positions room to breathe and develop over time. Here's a solid solution for nailing your stop loss placement. Make sure it's wide enough to withstand those normal routines or pullbacks in a trend to avoid being tree shaken out or stop hunted, but also wide enough that if the stop loss is hit, the trend has clearly failed. We're going for that sweet spot. The key is using average true range, or ATR. It measures a stock's volatility or how much it typically moves over a certain period. Let's compare two well-known stocks, Microsoft and Nvidia. Microsoft tends to have a weekly ATR of around $7. Nvidia, which is a much more expensive stock, tends to have a weekly ATR of around $31. So if you put a $5 stop loss on both Microsoft and Nvidia, you'll likely be stopped out on a regular basis. Instead, take the ATR and multiply it to give your position a wide enough berth. Let's use a 4x multiplier for example. For Microsoft, $7 times 4 equals a $28 stop loss. For Nvidia, $31 times 4 equals a $124 stop loss. You can see how this formula works wonderfully well as it creates a stop loss that is unique to each stock. And here's a pro tip. You can then turn that initial stop loss into a trailing stop loss that follows the stock's price as it moves up, locking in profit. Customize the multiplier as required to optimize your strategy, but use this approach of the ATR with a multiplier as a solid framework to keeping you in the trend through normal volatility, maximizing profit while getting you out safely when things turn sour. Our stop loss formula keeps us in winning positions typically for 12 to 18 months, allowing us to really go to town with compounding winning stocks and assets. Expression time again. You will be familiar with the trend is your friend until the bend at the end. Using this stop loss formula, as I've explained, in conjunction again with picking the right stocks, you can see how we've come back to mistake 1, is how you turn it from a phrase that is thrown around willy-nilly to executing it like a proper investor. Okay, and finally, mistake 5, a lack of patience. Instant gratification is a symptom of the online world we now live in. People want everything yesterday, and I mean everything. It doesn't matter how good of an investor you are or how robust your strategy is, you simply cannot force the market to pay you what you think you are worth. The market is a beast you cannot tame, and neither should you feel you need to. Instead, you want to learn to align with her, and that is how you will be handsomely rewarded. Here's what you must embrace. A trend and growing a portfolio are both a function of time. Let's look at fashion for a second. A good fashion trend stays in place for years, even decades. Bad fashion trend or a fad comes and goes and has a history of being laughed at. This is the same with good stocks and bad stocks. Bad stocks you want to leave well alone or you want to cut out of with an insignificant loss. Good stocks will trend for months to years where you want to maximize profit. Here's the thing. If you eliminate time, you eliminate the trend. If you eliminate the trend, you eliminate profit. Mastering patience is essential. So here's the solution to applying patience. 1. Use scanners and the 4PS method to shortlist stocks that are starting their move from phase 2 to phase 3 and phase 3 to phase 4. Allow patience for the stocks to go through these phases. Remove attachments to your favorite stocks and let the process dictate which stocks to invest in. Once you've identified the right stocks for the portfolio, apply patience for the right entry point into the start of phase 4. Wait for the end of day closing prices to confirm good entry points. Avoid intraday entry points as markets can swing towards the end of the day when institutional money flows in. Once in a position, allow patience for it to dictate if it is a winner or a loser. Expect a position to go against you first before returning a profit. This is known as stop hunting or tree shaking, and why a well-placed stop loss using the ATR formula I shared earlier with you in mistake 4 is crucial. Once a stock starts moving up, Apply patience for the trend to unfold over weeks and months. Applying patience for a trend to develop means being rewarded with the ability to add further positions or compounding as a stock moves up. The reward is exponential growth. There is no better feeling than seeing your portfolio perform consistently over time by simply having smart processes in place that compound your money away in the background to life-changing sums of money while you get on with life. There is absolutely no need to give up on your day-to-day commitments to be a better investor. Good investing is about doing as little as possible to make as much as possible. And there you have it, guys. 5 common mistakes that will be sabotaging your stock market performance and simple solution for each one to turn it all around. To wrap things up, here's a quick summary. 1. Implement a consistent process for picking the best stocks from the leading sectors. No more guesswork or blindly following the online hype. It all starts from here. 2. Define your risk parameters, capping each position at 1 to 2% of your account. Diversify across a basket of quality picks. 3. Wait patiently for stocks to prove themselves with the 4PS method. Enter at the start of a fresh phase 4 uptrend, not in the middle of the hype or at the end once a stock has gone parabolic. 4. Use a volatility-based stop loss to stay in a trend while cutting losses short. When you're right, press your advantage by adding strategically to your winners. And finally, 5, master patience. Embrace it as trends and portfolio performance are both a function of time. Time allows for compounding, which rewards us with exponential growth, a result few achieve. Follow these 5 steps consistently and watch your investing improve by leaps and bounds. Which of these 5 mistakes hit home the most for you? Have you been guilty of these yourself, like I was in my early days? Drop a comment below. I'd love to hear from you and your experiences and how you plan to implement these solutions starting today. And if you like the tips in this video, you need to download the Stock Market Blueprint, which you can find in the description below. It is a visual representation of our complete process from beginning to end. Just tap the link in the description to sign up. Remember, building wealth in the markets is a skill that anyone can learn with the right process and mindset. Until next time, stay disciplined and keep those profits rolling in.